So today the topic that I'm covering is the banking sector. Right? The question is whether it's a sunset industry or is it a sunrise industry. So banking is actually a sector that I've been covering since my time at Morningstar. I won't be going very deep into like my background, but basically just wanted to spend a few minutes covering our team, etc. Just a quick disclaimer, everything that we say here is obviously the stocks we are discussing are stocks that we are invested in. And so, if you decide to take any decisions, please either take our advice, or if you have another financial advisor, take their advice. And all of these opinions are obviously linked to our positions as well in the market. Can you see me? You can see me well, right? Okay. So our mission, at Opportune Wealth, very quickly, is to help clients gain equity exposure in their portfolio with the objective of long-term capital appreciation of their wealth. We do this through mainly long-term investing, and I'd say we try to pick out winners in a particular sector. And we have a full presentation where we actually discuss our entire portfolio strategy. If any of you are interested in seeing that, we have a recording of the same on a Google Drive. So I'm happy to share the link with you. For the clients, actually, we've already just sent out that email link, last week. We were incorporated 3rd May 2016. So we've just completed 4 years since incorporation. And we'll actually be completing 4 years since we started investing on 2nd September 2020. So yeah, that's our investing anniversary, 2nd September. We mainly do direct equity portfolios. We do offer mutual funds, but there are some regulatory changes that have now, made us separate our mutual fund clients completely from our direct equity clients. So as those things become clear, we may have to start moving away from mutual funds. So here right now, I'm just mainly talking about the direct equities, since this presentation is also about direct equities. So we run a concentrated 14 stock portfolio, which is mainly multi-cap, large cap, mid cap, and small cap. And it's a model portfolio driven. So that means we have a set allocation, and any new money coming in, usually we'd vary it a little bit depending on, in terms of valuation. If in case something's gone up quite a bit, we might take a little bit less of that particular company, and otherwise it's mainly model portfolio driven, and we have a set percentage. So currently our portfolio looks like this. It's basically banks is 17%, chemicals is 12%, consumer and retail 14%, financial services 30%, healthcare 10%, IT tech is 11%, and 6% is pharma related. So if you put healthcare and pharma together, it's about 16%. I made you meet my team. So essentially, this is the full-time team, and Simran and Asta have not been mentioned here since, they're interning. But essentially, I'm handling both the operations and the research, and we have both the advisory and the mutual fund division wrapped up into, one organization. This is our office, right now lying empty, thanks to COVID-19. But, we hope to resume office in the next few months as things settle down. And, hopefully we can have you come over for a coffee, or lunch when we're back in the office. But yeah, that's just a small picture of our office space that we rent out. So, I mean, I've been starting my webinars with the Buffett quote, because I think before I met Buffett in Feb of 2011, I was actually going to join a venture capital company, and I was going to, invest in early stage startup companies. And when I met Buffett in, Feb 2011, I realized that, Buffett is one of the richest people in the world. It's so easy to buy and sell a stock or a company on the stock market. You don't have to wait for a deal making. You don't have to kind of, basically in PE, you have to exit at the top. Otherwise, things dry up and you don't have to wait for liquidity. So that's what it made me realize. And my father had already been investing for 35 years. And so I already had investing in my blood. And so that made me kind of leave my venture capital job offer as I was graduating from my MBA and go into equity research instead at Morningstar. And so that started my journey in 2011. And in 4 years at Morningstar, I was basically able to find my calling, and I did pretty well on my stock calls, and I managed my own personal portfolio as well, which more than doubled in the 4 years. And, largely outperforming the Sensex as well. So I think this is a quote I like, if you don't find a way to make money while you sleep, you will work until you die. And so essentially our purpose with the stock picking is that we want to sleep peacefully at night, and we don't want to be doing, short-term trades that basically keep us awake at night. Sometimes, yes, we do put money in IPOs, and which give us a good kicker. And in our first few days, when we only had 10 clients, we used to actually sit and fill out those physical IPO forms and, send a peon door to door for him to get their signatures in the 3 days of the IPO listing. But we quickly realized that beyond 10 clients, and as soon as our clients stopped being from within Mumbai, we couldn't service them evenly. And my thumb rule has always been that if I can't treat, all my clients equally, then I'm not going to do it for, anyone. So we just stopped kind of doing that. We still send out our recommendations, and whoever would like to do some IPOs, they do, go in for that, but that's in their own kind of accounts. So, with that, I'll dive right into the banking stocks. These are the 6 stocks mainly that we're going to talk about. So just going back to Buffett's quote, if we just invested 10 lakhs in each of these 6 stocks, in July of 2010, then in the last 10 years, your money would have gone up like so. So HDFC Bank, you would have made 5 times your money. It would be 50 lakhs. Kotak, it would be 71 lakhs. So that's 7 times your money. Bajaj Finance, it would be 578 lakhs, so that's 57 times your money. Whereas, and these top 3 are 3 of the companies that are in our portfolio. The bottom 3, are the other kind of top out of the top 6 banks in India, I would say. So had you invested in Axis, it would be 1.8 times your money. ICICI would be 2.3 times your money, and SBI would only be 0.8. In fact, you would have lost, money rather than made money there. So I think, picking the right company in the long run matters. And that's what we're here trying to do. In fact, Axis Bank was one of our first stock picks along with HDFC Bank in our portfolio. But we quickly exited within 3 months, realizing that, this will not be a long-term compounder, and management wasn't doing the right things within the bank. So, a mistake realized early is always a good thing. What I also wanted to show you is that at the bottom of the market, right, in March, what these companies were, what your 10 lakh value of investment was worth. So, HDFC was at 42 lakhs, Kotak was at 67 instead of 71. So that's like, it was 16% down from your current value. Kotak was 5% down. Bajaj was 31% down. Axis Bank was 14% down. ICICI was 5% down, and SBI was 2%. So essentially meaning that, equities is not for the faint hearted. So with the dip in March, you basically had to see your returns get wiped out for some time. But then there's been like a quick rebound and a bounce back. And, that's what we're here for, to tell you that things will look okay. It's raining so heavily today and there's a storm here. But like, we know that in the next 48 hours, it'll all clear up and everyone can be out and about again, right? So similarly in markets, I think if you stick with the right names, in the long run, those should pan out. So essentially, this is the framework we use. Again, more about this framework and exactly how we go about analyzing each of these segments. And till, before a year ago, I used to do all of this myself. But now that I have a research team, everyone's basically looking at these 4 key criterias. And this methodology is detailed out in the webinar that we had on 20th June. I'm happy to send around the link to those who don't have it. But essentially it's select industries. So what Buffett also says, it's very important to pick the right industry. Even in the right industry, if you pick the wrong company, you might still make money. But if you pick a great company in the wrong industry, you're not likely to make money at all. So I think industry is the most important first checkbox. Then within the industry, we want to pick a winning company. So already in the first slide, we showed you that there are 6 companies, and of that we've chosen 3, right? 3 of the top lenders. So picking the right ones is important. And obviously the last 10 years is a backward analysis because our company doesn't even exist for 10 years. So it's not like we've been invested in them for 10 years. We've been invested in them for maybe 3 years, 2 years, and 1 year. But that's the track record that those companies have. Sound management. So the reason we exited, Axis Bank was sound management. Sorry, someone's not on mute. Can you put yourself on mute, please? Yes. So, sound management is another important checkbox, and there are many nuances to this. Sometimes, fraudulent companies are not known to the market or even experienced investors. I think Varun Beverages was a recent example that came to light. Then fair valuations, right? So again, fair valuations, one can say that valuations lie in the eye of the beholder, but essentially we're looking at, making a decent effort at doing a model, seeing the PE multiples and seeing what we're going for. So that's the basic framework. So I'll be speaking about industry first. And, because we have a variety of people here, someone who may be tracking markets, someone who may not be. So I'm just completely going down to the basics, and, happy to address questions later. If you feel like putting them in the chat box, I can also address them later looking at the chat box. So basically just wanted to explain how a bank works, right? These are the 4 steps. It's sort of making the infinity sign, which is part of the Opportune wealth sign as well. So essentially here is where it starts, right? Step 1 is when you save your money in a bank, the bank pays you interest. So it's like this circle happening, but essentially the deposits go into the bank. And then what the bank does is bank lends this money out as loans, right? And then people who are taking loans pay an interest back to them. So this interest comes back to them, and then they basically pay you interest, the depositor. And usually, obviously, the interest that they get from the lending is higher than the deposit interest that they have to pay. And the difference is called the NIMs. So the net interest margin is the margin of a bank that it makes on the, cost of assets, which is what they mean yield on assets. And I mean, I'll try to avoid using big names, but basically it's the interest that you get from the loans and the interest that you pay to the depositors. So it's the difference, which is the net interest margin. And we'll be sharing this later on each of our 6 banks. So essentially what we've seen in the last, say, 15 years, right, is that there's been a shift in market share. So the better run banks get even bigger over time and gain share. That's our key takeaway. And essentially, if you see the advances growth, right, in India, so this is the Indian, what do you call this, the 6 banks that we're covering. This is their market share combined. Back in 2005, of the total advances, by advances we mean loans. So the total loans in the Indian banking system, 30% of the total loans in the Indian banking system were given out by these 6 companies, right? And in 2020, over 15 years, that has become 50%. So not only have they gained in market share, so to give you an example, HDFC Bank, it was only 2% of total loans. And today it's 10% of total loans. But you can see that the pie is also growing. The pie has grown from 11 trillion rupees to 104 trillion. So that's a growth of 16% CAGR over the last 15 years. Which is why HDFC Bank, even though it's one of the oldest, it's the stock that everyone holds in their portfolio, it's still been able to double in the last 3 years, right now this point in time is actually a bad point in time to take, but say even December 2019, it had given you double your returns in 3 years, which is a pretty good return. And you can see that even in terms of deposits, right, these 6 banks were 31%, and now they are 44%, right? But look at the difference. Like HDFC Bank was 2%, and now it holds 8% of the market share in total deposits. The more a bank can have deposits, the more money it has to give out to lend, right? So essentially the fuel, the engine only starts at deposits. And so you can see ICICI Bank was 6% in 2005, it's still 6%. So what is grown at is just the growth of the pie. It hasn't really gained market share. You can see Axis Bank has grown quite well, 2% to 5%. But then if you look at, Kotak has more than doubled, it was 0% here. And it's 2% now. Bajaj Finance is practically 0% here. And now it's 0.2%. And I think we see huge potential here in Bajaj Finance. They can raise deposits really well. And they've been offering good interest rates and they've been getting good traction as well. Whereas if you see, the stalwarts like SBI, they've only increased their market share from 21 to 24%. So that's the largest. It's a PSU run company. And even on the advances front, it's only gone from 18 to 23%. And you can see that if we would, we've already seen the market cap and what kind of returns it would have given. It would not have really given you much return. So despite, so now we'll talk about, the NIMs, the net interest margins that we were talking about. So what we've done here is we've just put the 2010 NIM and the 2020 NIM. So over 10 years, you can see that HDFC Bank's NIM is actually shrunk 5.8 to 4.19. And right now it's at the 4% kind of range. 4 to 4.3% is what it was in the last quarter. And in Kotak, it's 5.8 and it's, come down to 4.9. Bajaj Finance, it's 17.7 and come down to 11.5. Now this is an NBFC. They have a different capital structure. So which is why they're able to get slightly better NIMs. They also lend slightly more risky, but we'll talk about that in the further slides. But you can see, SBI and ICICI Bank, they've actually expanded NIMs. But even though the NIM has expanded, they haven't really created shareholder value. So we'll go into more detail why, that is the case. But so despite the shrinking NIMs, of our 3 chosen lending companies, they have been able to expand PAT margins, via safer lending over the years. So I'll just move to the next slide to show you. So, Bajaj Finance, of course, has the highest net interest margins. But for all the others, right, like ICICI was at the lowest at 2.5, 2.5. And we can see Kotak is, right now at the highest at 4.8. So all of them are sort of range bound. So because the interest rates on deposits are quite consistent and the lending rates are also quite consistent, because if you see like a large conglomerate will obviously go to multiple banks to get the money. And there are a lot of, consortiums also together. All these banks come together to lend. And so the interest rates are quite tightly, knit. For the NBFC, on the other hand, because they do slightly more unsecured lending, they're dealing with individual customers, and there's not so much, buyer power. Whereas for banks, the large corporations, they definitely are able to swing their way a little more. And so I think that's one of the differentiating factors also. If you see, we've chosen more retail banks, HDFC Bank, Kotak, Bajaj. Whereas SBI, Axis and ICICI are more corporate banks, because the buying power, if you look at, Porter's theory, again, I've explained this in the other webinar, but essentially if you have less pricing power, if your buyers can, come together and ask you to lower a price. So this is just an analysis on, how, what proportion of each of these banks' portfolio is into unsecured loans, right? And the latest thing is the moratorium. With the whole COVID happening right now, the government has allowed a moratorium. So all the banks and lending companies are forced to give moratorium. So just a quick look will show you. So this large number on top is actually the total loan book size. So you can see SBI has the largest loan book, right? 5 lakh crore. 3 lakh crore is HDFC Bank. So it's almost half of that, right? And then you can see the unsecured loans in HDFC Bank are actually 31%. In SBI are actually 25%. But the moratorium book is almost similar, right? 9% is the loans under moratorium for HDFC Bank and 9.5% for SBI. And for the others as well, you know, I think 9% is the best number. Even Axis is at 9%. And the highest sort of unsecured loans is for Bajaj Finance. By unsecured, I mean that they don't have like an asset backing it. You know, it's not linked to a property or to a vehicle or to a, you know, consumer good. It's a loan which is not secured by an asset. So somewhere you can see that, okay, the unsecured lending book, whoever has the higher unsecured lending book is the one who's able to sort of pull a higher net interest margin, because they're able to lend at a higher rate, saying that, hey, I mean, you're not giving me a security, you're not giving me a house as a backup, so I'm going to charge you a little extra interest rate. But it's on them, or it's on the bank to get that, recover that money. And so why HDFC Bank has been successful is because they have a lot of, say, preferred customers, and they have a lot of customer data, and they keep digging up this data and figuring out who are the people to whom they can actually lend and be relatively assured that you know, the money will actually come back, versus you know, someone else, you know, one of these other banks who are maybe not so data centric and not able to tell who should they lend to and who should they not. So data in you know, banking has of course become very important. Moving on to the next slide. So just a sec, someone's not on me. Yes. So this slide basically talks about capital buffer. So as the money comes in, you know, deposits is not money owned by the bank, right? It's money of the depositor. And when they lend out, they're basically lending out money which the depositor has put in. So it's a liability which they are basically turning into an asset, cash, that they lend out. And so if the depositor ever comes to take back that money, they'll have to make sure that they have some money to repay the depositor. So capital buffer is basically like the equity capital that a company or a bank or a lending company has, which is important because the higher the liquidity, basically if the depositors come and they ask for their money back and your money is lent out and your lenders haven't given it back, then you'll basically take it out from your profits or from your equity and say, okay, I have this money sitting on my balance sheet, I'll take it out and I'll give it to you for now. So if there's like if there's a loss that the company starts making, this capital buffer gets slowly and slowly eroded. And so the capital buffer of a bank is very important because their main raw material is money. And so there are certain rules that are there. So I'll first talk about these two bars, right? So essentially, this first set of bars is the CRAR. So this is the capital risk adjusted weighted assets. So it's basically you know what it's called basically the capital coverage that a bank has. And so you can see we haven't included the other three here now. We are just all SCBs is the purple bar is for all the banks in the country. So that's the average in the banking space. And the next three bars, you know, the green one is for Kotak, the blue one is for HDFC, and the yellow one is for Bajaj Finance. So you can see, as far as the CRAR coverage ratio is concerned, all our three banks, Kotak, HDFC and Bajaj Finance, are way above the average. The average for the industry is 15%, and actually regulatory requirement is only 11%. So while all banks are above the minimum, there are of course some banks which are really badly off and they reach the 11%. So like just a passing example, right? Yes Bank would have reached that 11%, which is why they sort of went bankrupt. And that's why everyone's putting in money to buffer up their capital. So yeah, so this is a pretty good coverage ratio from our perspective. And tier 1 capital also, it's the minimum required is 5.5%, and most banks are at the 12% range, but all of our banks are way above the threshold. And way above even the average capital requirement. Then coming to the left hand side, right, even from a gross NPA and net NPA perspective, I think this is the first question that comes to everyone's mind, that once the moratorium period is over, once people are expected to repay, what will be the NPA situation in the banking space? And these numbers are of course historic as of 31st March 2020. But this is just to give you an idea that these banks are doing their calculations, and things might get a little bad from here, but they have a way of basically managing that downside. And so if you can see, in the Indian banking space, gross NPA is actually at 8.5%, but for Kotak it's 2.2, for HDFC it's 1.3, for Bajaj Finance it's 1.6, despite their unsecured lending being the highest, etc., etc. And same thing with the net NPA, right? 3% is what the net NPA is, and the Kotak Bank net NPA. So net NPA is gross NPA minus provisions. I'm going to try not to be too technical, otherwise I will, lose your focus. But essentially, instead of 3%, which is what it is for the all banking industry, all of our companies are at below 1%, which is great, which gives us confidence that these are companies managing their non-performing assets. Non-performing assets are basically people who don't repay, bad assets, bad debt that needs to be eventually written off. Any loan that is beyond 90 days unpaid, goes into this NPA number. So moving on. So on the balance sheet as well, how they manage to maintain this capital buffer, I think, is each bank you can see is very different. You can see HDFC and Kotak have like some borrowings from abroad. So HDFC has 19%, Kotak has 10%, Bajaj has 8%. So, so everyone's, I think, strategy is very different, but they somehow kind of manage. So they are very individualistic as banks and lending companies, but they've managed fabulously. So on the industry, the other trend that I wanted to discuss was the digital payments bit. So essentially, this entire section will talk about, how the digital payments situation is evolving in the banking space. I'll just give you a minute to see this. So this slide essentially, goes from May 2011 to May 2020. It shows us the digital transaction volumes. So it's the number of transactions that are happening digitally, in all of India. So, we can see here that this blue bar is essentially the ATM share, right? And you can see that the ATM share is almost the same level where it was in 2011. But of course, just do note that the May 20 number might be slightly skewed only because right now we're in lockdown. So obviously people are not going to ATMs at all. So maybe if we take the May 19 number, you can see that the ATMs are, improving, but some of these other sort of avenues are more popular. You can see how UPI has basically just come in 2017, a thin blue bar here, and how it's grown as a proportion of the transactions. So while this is number of transactions, and you can see UPI is, showing like a huge market share. Let's go to how the value match up, right? So this is the value of digital transactions, right? So over there we could see UPI was the most popular, but here if you actually see UPI by value, so this means how much money has been transferred. You can see that only 2 trillion rupees is being transferred here, versus through NEFT and RTGS it's 85 and 92 trillion Indian rupees that is being transferred. So even though NEFT and RTGS, I'll just flip up and down so you can see NEFT and RTGS was such a small portion of the total number of transactions. In terms of value, it's still NEFT RTGS is the largest proportion of the total volume, and so it's probably just the smaller transactions that happen over UPI, POS and ATM, but the larger transactions don't. Give me just a second. Yes. So, sorry, just one last point here. I think so the value of digital transactions should catch up, but trust builds over time. So right now the volume, the volume is high, but the value is low. And our guess was that the NEFT RTGS mainly, it's mainly the corporations, it's the companies, it's the large value transactions that people are obviously not comfortable doing over a POS or a UPI transaction. And so over time, hopefully, UPI might start being used for larger transactions as well. So from an industry perspective, right, transactions we mentioned we were moving up, and yeah, I mean, this is just the same thing, just put up a little differently, saying that 230 are the volume of transactions through the NEFT RTGS, and 180 trillion rupees that gets transacted. So NEFT RTGS is like the most popular right now. This is also just to show in India what is the basically how many, there are 3 data points here. This is how many number of ATMs there are, right, between May 2011 and May 20. So there were 0.8 lakh and now they're 2 lakh. So it's only doubled in the last 10 years. Whereas if you see the POS machines, right, it's nearly gone up 10x from 6 lakhs to 50 lakhs, right? And the number of debit cards, so plastic money, has gone up 4x. So, and just to show you the CAGR growth also makes this very apparent. For ATMs, the growth has only been 11.8. POS machines, it's been 26.6%, and for cards, it's been 15%, right? And this is just to give you an idea, okay, who are the top 3 by market share in each of these spaces. ATMs, it's but obvious, it's SBI, and that's part of their what do you call it, their business strategy, and we'll talk about it later as well. But they basically want to be the banker to every Indian. That is their slogan as well. So they want to have outlets everywhere. So that also comes at a cost, right? Setting up ATMs and branches all over the country in remote places. I think my connection is unstable. If I get cut off, Aditya, just tell me to repeat. So essentially, they have a higher cost structure. All SBI, Axis and ICICI Bank are all 3 relatively higher cost structures. That's how they are in the top 3 here. Whereas our 3 companies, HDFC, Bajaj and Kotak are not in the top 3, because they have realized that everything's moving digital. There's no point in building more branches and ATMs. They're already shifting their business model. The top 3 in the point of sale is Ratnakar Bank, HDFC Bank and SBI. In the top 3 in the debit cards and credit cards, again, SBI is probably the highest also because of the debit cards. the data doesn't kind of distinguish between. So yeah, I think Aditya just told me that you guys lost me when I was talking about how HDFC and Bajaj Finance and Kotak have basically realized that they don't need bank branches and ATMs so much anymore, and so they're already changing their business model to be more digital. Whereas you can see that SBI and Axis Bank and ICICI Bank, we'll show you later on that they have a more cost heavy structure. And I think I mentioned these. I'm not sure if you heard me, so I'll just repeat. The point of sale, Ratnakar Bank is the largest, and HDFC is second, third is SBI, and here in credit cards and debit cards, SBI is the largest, then Bank of Baroda, and then ICICI Bank. Right. So we'll move to the next slide. So this is where it comes down to, right? Operating cost to income. So basically it's operating costs, total operating costs to the revenues that a bank earns. So here we haven't put the numbers here, but it's obvious to you that say HDFC Bank is lower than a SBI, right? And between 2010 and 2020, the SBI cost to income ratio hasn't really changed. So they haven't changed their cost structure in any way. ICICI Bank, on the other hand, has, the cost has actually shot up instead of coming down, right? For Axis also, the cost has remained the same as a proportion, right? But whereas for these three, HDFC Bank, Kotak and Bajaj Finance, you can see very clearly that they have been cutting their cost. And a lot of this is, thanks to them realizing that they don't need to build so many branches and ATMs, and they can do with fewer, and moving everything digital to the extent that they can. I think the 2019 annual report of HDFC Bank had a cover which basically was a robot, and so they have even like a bot chat where online, if you go on their website, you have a simple query, it'll be answered by it's not really a robot, but essentially there are a series of algorithms that are answering your typical questions. If they see a question on statement, then they tell you. Coming to the last leg piece, right? The PE multiples. It's essentially what we saw in the last 3 slides as well. We've just put all of that here. So just how the prices have moved. So the blue line is the bank Nifty, and the red line is the HDFC Bank. And so the solid lines are the actual PE moves, and the dotted lines are the average PE moves for each of them. So you can see where, like, we can see that banking was quite overvalued, right? Last year, between June and December 2019, almost all the banks made their highs, and then now they're near their the average PE multiples. HDFC, in fact, is lower than its average PE multiple, but they're getting close to their average PE multiple. So it's typically like that, very lots of ups and downs, but eventually I think slowly it'll be moving up, and you wouldn't even realize when you, like I said, tripled or doubled your money. So here we quickly share the forecast that we have. So we have a model on each of these companies, and we're looking like a 5 years, 6 years out. This is like a 6-year out projection, but essentially over the next 5 years for HDFC Bank, we expect that the total income to grow by 2x, and the profit after tax to also grow by 2.6x. And typically share price moves up with the EPS and with PAT growth. So that's our expectation. And what we aim to do with our portfolio is also double every 5 years. And so essentially, this should help us meet our target. Same with Kotak. Kotak, I think, is, again, it's a smaller company. There are a lot of there's a lot of potential in Kotak. There are a lot of small pieces of the puzzle that are still inside. If we sort of do a sum of parts analysis for Kotak, there are lots of different angles which they can basically monetize. So we see a lot of potential in this, smaller bank. Even though the PAT we're only estimating at 2x for 5 years, but a lot could change, very quickly if they decide to monetize any of their individual assets. Bajaj Finance, again, we expect it to go 2x in the next 5 years, and you can see that our PAT expansion actually, in the 6th year is more than 2x. So if it's 5.8 here, 11.7 here, that's double. But if you just wait one more year, it's 14. So obviously things keep. That's how you get compound interest, and that's how you get compounding in the market. Just a quick look. You always look at PE multiples, PEG ratios, and price to book. And this is just the few banks that we were discussing today. So if you just take your, view on this rightmost column, we can see that HDFC Bank is at 3.2 price to book. Kotak is at 3.6. Bajaj Finance is at 6. You'll say like, this is ridiculous. Like, why are we holding this at 6 price to book or like 39 PE? But then you glance at what lower PE multiples or price to book will get you, right? Axis Bank says at 72 PE, and it's for 1.4 price to book. But like you remember, Axis Bank would have only doubled your money in the last 10 years. So do we want to double our money, or do we want to make it 5 times, right? So essentially that's the difference. Like, quality is always at a premium, and just like you pay more for a Louis Vuitton bag versus like a regular bag or like a Coach bag. It's just that you think that the Louis Vuitton bag is a higher quality. They've spent so much on branding, and that bag costs more. So I think in the stock market as well, you have these quality companies which will sometimes trade cheaply, like in the COVID-19 situation. But I don't think there were many buyers sitting to buy it because the whole situation had changed. But on average, these typically trade at a higher multiple, and it's worth getting on to that ride. With that, I'll end, and thank you so much for your time.